Go to Dave. Dave calling us from Pennsylvania. Hey, Dave. Good morning.
Good morning, Dan. Happy New Year.
Thank you.
Yes, I have a question regarding how to evaluate having an investment advisor versus doing it myself, and I'm specifically interested in hearing more around your thoughts around how to have discussions around judging their return and evaluating the value of paying a 1% fee.
Mm-hmm. Okay. Great question. Here's the thing, Dave. First of all, if you have a good, trustworthy advisor, someone that is got your goals and objectives in mind, not their goals and objectives. Now, let me just say off the top, I believe that investment advisors ought to be investment advisors, not insurance advisors or bank advisors or anything like that. They ought to be people that are engaged in the investment industry. They ought to be somebody that you can ask a question. If I want to buy 20 shares of Ford Motor stock, can you put that in my account? If they say no, or they hem and haw, and they're only mutual fund kinds of people, that would be a red flag to me. They should be able to do anything from CDs to individual stocks to ETFs, mutual funds, whatever it is you want to do. I think the value of a well qualified, trustworthy advisor. I have no problem whatsoever about a 1% fee. I don't have any problem about a 1.5% fee. I don't really have an issue with fees. Now, I'm a guy that used to be in that business, so I manage hundreds of millions of dollars, and of course, I would say that. I mean, I don't any longer. I don't do that any longer, so I have no reason to say it now, other than. It's there shouldn't be an issue with anybody having the right to earn a living by what they do, and there shouldn't be an issue with anybody paying for that. And again, if they're doing a good job, it's going to be insignificant. It's going to be so insignificant. Traditionally, someone that has a well-trusted, a good advisor does better than somebody that doesn't. Now, that's not necessarily because they're really smart. It's usually because if they're good and trustworthy, they're going to tend to hold your hand through the bad times. So, the good advisors didn't let their people get out of the market in 2008 when it all came tumbling down. They didn't let them have it. They might have cut back. They might have gone to significant positions in cash, but they didn't let them just get everything out. So consequently, those people did a lot better than those that just said, that's it, I'm getting all the way out. So there's a lot of good reasons for it. And I think it's great. My issue with, I truly do wish that there were a group of advisors somewhere out there that I could recommend. People ask me that all the time. I've stopped doing that. I don't go there anymore. The reason I don't go there anymore is because, first of all, I place a great deal of value in the trust that my listeners put in me. And I can't recommend anybody that's not going to do what they say they're going to do. And that seems to be the norm, rather than the exception. So I don't recommend anybody, but there's plenty of good ones out there. Now, so I don't have issues with that. I don't have issues with the fee. I think the real issue, the real difficult for you and everybody else, Dave, out there, is to find and to know who is that trustworthy person. As far as their returns, again, their returns are almost insignificant because nobody out there is going to tell you about bad returns. When unless you've been involved with them over the last 5 years, and you say, well, in the last 5 years, in general, the markets have been up, I'm making a number up here, 15% on average, and my market exposed holdings, I've been down 5%, something's wrong with that picture. Then you can make a pretty true and right judgment on, their returns. But to ask somebody about their returns is almost crazy because, you're going to get good returns. That's a difficult part. You've got to go by word of mouth and someone that you trust to give you a good referral.
Yeah, I've been with them for about a year and a half, and I would say my market exposed returns about even with the indices.
Mm-hmm.
And I think the question is, do you evaluate them over that time, which I could clearly do the indice investing myself,
Mm-hmm.
or is it more in the hard times on how they make their decisions?
Well, I can only, in my opinion. So here's what I used to tell people that when I was managing hundreds of millions of people, a lot of high net worth, hundreds of millions of dollars, a lot of high net worth people, they would come to me and they say, Dan, we really want you to manage our portfolio. And I used to tell them right up front, look, if the market is up 20%, 25%, and you want me to be up 20, 25%, it's never, ever going to happen. I can tell you, I've been doing it 32 years, it's never going to happen. But when the market's up 25, I may be up 18, but I'm never going to be up 25. But when the market's down 20, I'm going to be up 3 or 4. So, but that was my style of invest. But that was all my analytical work. All my style was based on downside return. I never, because frankly, when times are good, you don't have to be that smart. I mean, everybody's making money. I mean, it usually all boats rise. So I never concerned myself with that. But because of my conservative approach and my protection on the downside, I wasn't exposed to those heavy hitters in the good times. So my portfolios never did what, a lot of others were doing in those good times. And I used to have people say, well, you know what, Dan, I appreciate your honesty. I don't want to, that's not what I'm looking for. And I would be okay with that. I used to tell people, if you don't want to pay taxes, you got the wrong guy. Because if I'm managing your money, you will pay taxes. Because I was a profit taker. If, I had a stock and was up, I didn't do mutual funds, still don't. But if I had a stock that was up 35 to 85%, I was probably taking it. And you got to pay the capital gains tax on it. And I would tell people that. So I'm not going to manage money because I'm worried about you paying taxes. Never have done that. Never will do that. So it really depends on the style. So since you asked me the question, I would tell you that from my perspective, I think it's far more important of what's going to happen on the downside, not what's going to happen on the upside. I'm okay. If you can be okay with saying I'm okay with 18% when everybody's up 25, I'm perfectly okay with that, to get that downside protection. The other thing that I would be concerned about and looking is, I know someone that manages institutional money. And as a matter of fact, manages some of the institutional money for an organization that I work with. And this person said to me one time, well, we don't do any kind of economic analytical work in deciding how to manage. We don't do that. So we're just trying to predict what the economy's doing. I said, well, okay, good luck with that. But I wouldn't want that. See, I want somebody that's got their ear to the street and can take a realistic view of what's happening in the global economy and the macro economy here in America. I would want somebody that at least has their ear to the street well enough and knows the companies in which they trade in to say, I believe, based on, maybe they're basing it on trending, maybe they're basing it on charting, whatever they're basing it on, I think the economy, they're well versed enough in the economy. That includes the politics of it all and all that other garbage, to say, we're much more likely to do this as opposed to doing this, and would manage accordingly. Very few do that. Used to be 20 years ago where everybody did that. Not so much anymore. So if you are an advisor, I would say this to you, Dave, if you're a guy that's got exposure and it's all indices, and you're just kind of getting a broad shot at the economy, at the markets, and that you're happy with that, and you're just going to go as the indices go, I wouldn't pay 1%. I would go to Vanguard and get their S&P 500 fund, or get an indice fund and just sit on it and forget about it. You don't need to pay somebody to do that. So does all that make some sense to you? Does it give you any
No,
clarity?
that's helpful. And it's not just indices, but that's good to know. I mean, it's ultimately how you judge versus your portfolio versus what it would be in the market.
Right. Well, and that's, I'm glad you're decided to go into 2014 and get a little bit of a better perspective on all that. So, I just think that, I tell people that have been in the markets for a while, trust your gut. Try to do the best you can to be up on what you feel is going to happen, and try to live and die by your strategy if you really believe in it and you trust in it, and not, jump in and out and all over the place. Don't react to good news, bad news. Don't sell on bad news and buy on good news. And, don't try to get over enthused about anything. Just try to stay steady, even, and more importantly, disciplined. And if you're a person that can do that and continually invest, on a dollar cost average basis and things, you're going to do fine. I mean, it's going to be hard for you not to do reasonably well over any 10-year period of time. And, that's just my thoughts and opinion on it.
Thank you.
All right, Dave, I appreciate the call. Thank you so much.